How you guys doing? My name is Josh Pro and welcome back to my channel. Today we're going to talk about how you guys can figure whether or not you're ready for retirement with a very simple calculation or formula. I'm going to walk you guys through that. The first step is to calculate your retirement expenses. Calculate your expenses. Now you have to remember that your expenses are made up of two parts. The first is going to be your fixed expenses, and the second are your variable expenses. Your fixed expenses are going to be simple to factor. When you open up your bank statement, you'll see those reoccurring expenses, the mortgage, utilities, cell phone bills, things of that nature. The one that most forget about are the variable expenses. These are things that don't happen. It's more sporadic. They don't happen on a monthly basis. However, these expenses make up for 30% of the average household expenses, whereas your fixed expenses will make up for the other 70%. The reason this is important is often when we're sitting down with clients who we've asked to go out and do an exercise to calculate their expenses, we'll omit this 30%. And when they get to retirement, they're going to have an issue because they're spending more than what they assumed they were. The next step is going to be calculating your income, your retirement income. What is your retirement income made of? Well, there's a few different components you typically have as it pertains to retirement income. And these are what we call secure retirement income resources or sources. Everybody knows what Social Security is. 40% of your income will come from your Social Security benefit. 40%. The next will be pension. Now, not as many people receive pensions today as they did before, but that'll make up for another very large percentage of your total household income. So if you've got 40 here, typically you have another 40 or so percent coming from pensions. Could be more or less. And then lastly, another income source is going to be your 401ks, IRAs. You could have SEP, Simples, 457, anything that's going to be classified as retirement savings accounts. Could even be a Roth IRA. These are the core components. Now you do have this last item here, and that is going to be figuring out the difference between these two. So it's rather simple. We take our monthlies, our monthly income, and we subtract that. We subtract our expenses from that monthly income. Okay, and the difference between those two is called a shortfall. Now, you may or may not have a shortfall. Most people will. Most people's income from Social Security and their pension will not be enough to cover their expenses. Now, let's go ahead and take a look at an example of that. So let's just assume we've got a couple whose monthly income, let's say we've got their income here. We've got their income, and we'll say their SS benefits, so SS is equal to $3,000 a month between the two of them. So maybe like $1,500 per individual. And then they've got pensions, say, pension income equal to, let's say, $2,000 between the two of them. And this may be less or more for you. Don't worry about it. We're just doing an example here. So they've got a total income, total monthly retirement income of $5,000. Now let's say after they factor both their fixed and variable monthly expenses, their total expenses for the month are, let's say, $6,000. Okay? So, as we saw earlier, what we'll do is we will subtract their expenses from their monthly income. So we've got $5,000 a month coming from Social Security and pensions, minus $6,000 a month is their fixed and variable monthly expenses, and the total of that is going to be negative $1,000. So they will be short $1,000 per month in retirement after all said and done. Now, what we do next as retirement income planners, and what you guys can do in this exercise, is you'll take that $1,000 and you'll annualize it. So you times it by 12. Annualize means just how much is that negative over the course of a full year. And that ends up being $12,000. Okay, that is their shortfall. That is their annual shortfall. It's a very important number. So the question is, where are they going to get this $12,000? Okay, that $12,000 is the reason why you have retirement savings. You've got retirement savings, right? You've got retirement savings. Retirement savings accounts. Okay, and you may have different things like an IRA. You may have a 401k. You may have a 457 plan, and so on and so forth. You could have a Roth. You could have a brokerage account that you pay tax on, that you're paying tax on annually. Let's assume that this person has an IRA with, say, $150,000. They've got a 401k with, let's say, $100,000. And they've got a 457 plan, we'll just say, of maybe $50,000 from a former employer. All right, so we'll take the total of that. We've got 50 and 150, 2 plus the 1 is 300,000. Now, the reason you have saved this $300,000 in your retirement savings is to supplement the shortfall, is to cover the shortfall, I should say, to supplement your both Social Security and pension income. So now the question is, if we've got a $12,000 shortfall, we've got to start taking a withdrawal from this $300,000. But then there's a risk. There's a risk that $12,000 over, say, the course of 10 years is $120,000. Over 20 years, that's $240,000. There is a risk that you could run out of money during retirement, especially with the rising cost of goods and services. We saw Social Security in 2022 put up, 8.7%, and then 5.9% this year. That's a pretty extensive increase to the cost of living. So you'll need more and more from that $300,000, and so the chances of it surviving are smaller each year. Inflation grows higher. So what do we need to do? We need to make sure, first of all, that we're setting up a distribution plan to take the $1,000 a month from this account, or $12,000 a year. And secondly, we need to earn as much in the market at minimum as we're withdrawing. And we call that, we want, our desire, it's not our desire, our need. We've got a need here. And our need at minimum is capital preservation. Okay, capital preservation, meaning that we're living off the interest alone. Now, what do we want? What we would really like to have is capital appreciation. Capital appreciation is what we want. That is what we desire to have. Capital appreciation meaning that not only are we generating enough off of our retirement savings to cover the $12,000 annual shortfall, right? We've got negative $12,000 needing to come from here. Not only enough to cover the $12,000, but also to get a little growth on that money so that it's not depleting, it's not preserved and just kind of maintaining itself, but that it's growing a little bit over time, right? So you'll have capital preservation, capital depletion, and then you've got a kind of an upward swing growth or appreciation. This is what we want to happen. This is what we need to happen, and this is what we don't want. We don't want capital depletion. Okay. So the question is, how much is this $12,000 as a percentage from our $300,000, and can we maintain that in the markets? So if we do the math here, we would simply divide these. You'd actually do 12,000 divided by 300,000, and the answer to that is actually 4%. In other words, this is our golden number right here. The most important number as it pertains to this retirement calculation. We need to earn at minimum 4% per year to generate $12,000 to cover our shortfall. Now the question in our minds as retirement planners, is can we achieve that? And how much risk do we have to take in order to achieve it? Now 4%, between 4 and 6 is typically the range you want to see. So if you calculate this and you're looking at 7, 8, 9%, typically that's a signal that you'll have to continue working until you get within that 4 to 6% range. 4% for this individual is great because right now, to give you an example, T-bills, right? T-bills, where we invest many clients, they're currently paying about 5.4%. It's about 5.45% on the 3, 6, 9, and 12. The yield curve was inverted, meaning that longer term rates were paying less, and now those are kind of leveling out. But even the 3-month T-bill is paying 5.5, almost 5.5%, 5.45%. That means in this case, if we do the difference between the 4% we need to have capital preservation and this 5.45% we know we can generate out of T-bills, we actually have the difference there, if we subtract those two, is 1.45, that's a 5%. We actually have capital appreciation. This is what we want to happen in retirement. So this person would be in a pretty good place because they're looking at 1.5% annual appreciation. And so that's great. They can easily make the distribution on an annual basis without having to worry about running out of money. Monies will grow by 1.45% each year. That will help them keep pace with inflation. So there is a little more to the story. And that's because we have not calculated tax. I don't want to make it too confusing for you guys. But this $12,000 would actually be more because you'll need to pay tax on it. You'd have to do a post-tax assessment here. So how do we figure out how much $12,000 is before tax? And that's also a pretty simple formula. And first of all, you need to know what the average retiree pays in tax. And I can tell you what that is. It's between 10 and 15% on the federal and about 2 to 5% in the state. So if we go on to the high side of that, we're looking at 15% in the federal and 5% in the state. So they can expect to pay 20%. So to figure out what their pre-tax withdrawal would be, we do 20% of 12,000 and add that back on top. So 20% times 12 is 2,400. So realistically, they will need to withdraw. Instead of 12,000, they will actually need to withdraw negative 14,400. 14,400. That's their negative. That's their actual shortfall, and this is going to be pre-tax. Their pre-tax withdrawal. Pre-tax withdrawal. Okay. All right, so now we do the same thing that we did earlier. We simply divide the 14,400 into our 300,000. 14,400 divided by 300,000 is our magic number, 4.8%. 4.8%. That is how much they'll need on an annual basis from this account. So if you multiply 4.8% by the 300,000, it gives us our 14,400. So in that instance, like earlier I said, T-bills are paying that same 5.45% as of September 22nd, 2023. We still, if we subtract the two, we still are positive 4.8%. And what does that equal for 5? We've got 5, 4, 1. 145, I think it is. 1.45%. 45, it should be 3.5, I believe. 1.35%. So we're still in a good place. We still fall into our capital appreciation, which is what we want. Thank you guys again for tuning in today, and we do look forward to seeing you in the next video.